Hello and good afternoon to you all from Stockholm and from Moscow. Welcome to one of our webinars. Today we're focusing on emerging markets. This is a webinar in a series of other webinars that you may also watch. We will be also talking about China and frontiers and Eastern Europe. But kicking off with the schedule of today, just to introduce myself, my name is Beatrice Bushati. I've been at this capital for more than 10 years. I actually started summer 2008, which was perhaps not the best time to start, but quite interesting. And with us, we have some other people that have been around for quite some time. Anders Borg, former Minister of Finance of Sweden, and Senior Advisor Office Capital. We have Peter Elam Håkansson, CIO Office Capital and also the founder, so more than 20 years of experience. And from Moscow we have Jacob Grappengieser, partner and deputy CIO. So just kicking off immediately, Anders, I believe that you were fairly constructive on what the central banks would do and on the US president election last year, even though, of course, we have the pandemic, which was much more difficult than we all expected. Unfortunately, we've been home for longer than we wanted to. So could you please tell us what is your outlook for this year?
Well, I do think that 2021 is going to be a fairly strong year and that we're also going to have a decent backdrop for 22, even if it's early to say. We are looking at the world growth around 5%, advanced countries around 4%, and emerging markets obviously closer to 6%. I think the main reason why we've been able to recover in such a rapid pace after COVID is basically that we've had a lot of policy support, and that the policy support is also going to be there for 21 and 22. One factor is obviously fiscal policy, a lot of heavy lifting during 2020. But I mean, we can already say that we're also going to be quite supportive in 21. The debate in the US is still ongoing, but it's quite likely that we're going to see a fiscal package close to 10% of US GDP, almost 2% of global GDP. One should also note that China, that is a substantially bigger part of the global economy today than back in 2008, are also very constructive when it comes to fiscal policy. We are not seeing any deficit reduction in China for 2021. And I also think that it's interesting to note that the bond market, in spite of this very expansionary fiscal policy, really haven't seen any kind of negative feedback loop. So interest rates are low in spite of very active fiscal policy. Also, when you look at monetary policy, it's quite clear that it's very expansionary. If you look at the emerging market space, the average interest rates from the central banks are close to 3%. And given that we have an outlook for inflation in emerging market around 4%, we are going to see negative real interest rates that is obviously going to be supportive. And there are a couple of factors that one should mention. The dollar has been strengthening over the last few years, and this I think was helpful because it has meant that it has depreciated during this crisis. If I go back to the crisis that I worked in since the 90s, a traditional pattern has been that the US is a safe haven and that we see an appreciation. So the fact that the dollar is soft and can remain soft implies that emerging markets can really use monetary policy as a tool. And also when you look at the global banking system, it's pretty clear that we are in a decent shape. There are obviously always exceptions, but when you look at the Q4 reports, it's quite clear that banks have strong capital. The NPLs have been kept fairly low, and this means that the transmission mechanism for monetary policies is working. And also the housing market. I mean, a standard economic crisis is a real setback on houses prices, and that we haven't seen. So the construction sector will also be a factor. So from this overall point of view, I think there are a couple of points one should make that is helpful for emerging markets. The commodities has been stable, obviously driven by recovering in demand. We also have a geopolitical situation where the Biden administration is likely to take a more constructive attitude and a less uncertain attitude than we've seen during the last few years, and that's helpful. In the short term, we have a lot of uncertainty on COVID. It's clear that the numbers are coming down, particularly in Asia. India and China are two examples. But we still don't really know how effective the vaccines will be in kind of opening the economy. So in Israel, they have vaccinated 50%, but we have still seen quite high number of new cases. Mortality has been falling over the last few days, but we haven't really seen yet in Google Mobility and other indicators that they are really opening up. If the trend of the last few days can be sustained over a couple of weeks when the bigger part of the elderly population is vaccinated, well, then we could probably see Israel as a roadmap for the rest of the world. So I do think that we have a lot of uncertainty. There are risks. We could see inflation coming back on the agenda, but with quite a lot of spare resources and quite large output gap, I think this is a little bit into the future. So I do think that we have a very constructive backdrop for emerging markets. We have strong growth in 2021. We have very expansionary policy overall, not the least in the US, but also I would say broadly. And we also have a COVID situation that is problematic in the short run, but we are basically slowly moving out of that as a main risk factor, particularly if we're looking at the Asian markets. So I think 2021 is a very, very constructive year for emerging markets.
Mm-hmm. And when do you think the actual turnaround will be this year, or the trough, so to speak?
Yeah, I mean, obviously Q1 will still be weak because we still will have a lot of lockdowns. Q2 will be the balance point. If we're optimistic and can see that the Australian mortality drops early, then I think we'll probably see a rebound of activity already in Q2. But we can also have a longer scenario where we're actually we really don't have the rebound and the opening up and the release of optimism until the autumn. But it will happen during this year. Of that, I'm quite certain.
Okay, thank you. And also, before we continue, I need to urge you to all ask questions. So we very much look forward to answering them. And with that, I would continue with you, Peter, and moving back to emerging markets. So what are the things that are on your mind?
I think it's fascinating to see the tech transformation of the emerging markets, because for many people to think about emerging markets, immediately people think about commodities. And yes, it is important, but when we see how the index is composed these days, in the global emerging market index, some of the biggest stocks there are fascinating tech stocks. You have Tencent and Alibaba from China. You have TSMC, the Taiwan semiconductor manufacturer in Taiwan. And these are giants, and they're doing really well at the moment. Another interesting thing, which we also track when it comes to emerging markets, is the participation of the retail audience or the retail savers in different stock markets. And we have seen in Russia, for example, with the Tinkoff app, which a lot of people use to participate in the market. We also have some interesting facts from India, where you have this Zerodha, the Indian Robinhood, which had more daily trades per day in 2020 than actually Robinhood itself. So things are definitely changing. Also in a kind of old classic, maybe kind of more perceived as an old-fashioned economy like Poland, the largest market cap these days is in tech as well, Allegro, e-commerce, CD Projekt, which is game developer. So things are changing. And this is very much on our mind when we're investing. And we've been around for quite a few years, almost 25 years now. And during this period, we have seen that the part of the world which is emerging market is now more than 40% of GDP. It used to be around 20 when we started. But still, only about 20% of the market cap is emerging markets.
And when you mentioned that, this is actually the first time. Just 2 weeks ago, emerging markets index was back to 2007 levels. Obviously, emerging markets were not in vogue for a number of years. However, I think that the consensus is that this is now changing. So we are very positive on the emerging markets for the years. It would be great to hear from Jacob why we believe so.
Yeah, we have 6 key reasons why we like emerging markets. Anders mentioned economic growth, but it's maybe worth repeating it. There will be the highest global growth for 44 years, which I think is good for all markets, but I mean, especially good for emerging markets because that's where we'll see the highest growth, especially powered by China. On the interest rate side, the equation is a little bit different compared to developed markets. So in all the large emerging markets, interest rates have been coming down a lot. Just to put things into perspective, in Brazil, 3 years ago, interest rates were 10%. That's the central bank rate. Now it's 2%. In Russia, 3 years ago, it was 10%. Now it's 4.25%. So this, of course, leads to hypothetically lower discount rates, which means that equities should have higher valuations. But in practice, it leads to a lot of inflows to the equity market from the local investors and also the local retail investors. So we are seeing a retail boom all across the world. But in the case of emerging market, it is very much driven from the fact that you no longer get any good interest rates on your bank account. It's as simple as that. Of course, if you're getting close to 10% on your bank account and now you're getting 2%, you put the money into the stock market instead, and maybe you get a dividend yield of 10%, which is what you have in some of these countries. So this is a key driver. I think Biden in the White House just means lower global risk premium overall, and especially for some emerging markets like China, no announcements of new trade war with China, etc. So I think lower risk premium is, again, theoretically good for valuations, but it also makes investors slightly more, I guess, confident to put money into emerging markets. In terms of the global stimulus, yeah, I mean, I absolutely agree with Anders here. If we put some numbers, in 2009, G4, so US, EU, UK, and the US stimulated by 7%, i.e. 7% of GDP was the growth of their balance sheet of those central banks. Now the corresponding number is 29%. We did not get any real inflation after the global financial crisis. We got some sort of an asset inflation or increase in asset prices. For the past 10 years, the S&P 500 is up 350%. And part of that is probably driven by all of the money that was de facto being printed back then. Now we are seeing a 4 times larger stimuli. So the question is, where will the money go? And I think the answer to that is probably that it will go into equities, both in developed and emerging markets. But of course, the growth will be in emerging markets. So it's more natural, I think, for the money to go there. A softening dollar, it's good for all non-US assets. And I also think that some of the currencies in emerging markets are probably a bit undervalued. China with its economic strength, it's not difficult to see the renminbi moving higher. The Russian ruble, where I am, has been very weak, so it's also not difficult to see that one moving higher, etc. So I do think you'll see a softening dollar and a continuously softening dollar against some of the emerging market currencies. And finally, I mean, just the numbers then, I mean, so 2021, you're looking at a 33% TPS growth in emerging markets versus 20 for the S&P. And then emerging markets are trading at a 30% discount to the S&P. So it's simply cheaper and with higher growth.
And while we're still, to continue a bit on the topic where the money is actually going, another sector would be, or another trend is ESG and sustainability. And at Is Capital, we are working a lot on that topic, and that is actually the DNA of the company as well. So Jacob, how do you see this panning out going forward?
Yeah, so if you look on the flows last year, you had roughly $150 billion out from broad equity funds and 150 billion inflow into ESG funds. So it's clear that the money is going out from, let's say, regular funds and into ESG funds. These are quite big flows, and you probably want to be positioned a little bit kind of ahead of everyone else, or in the direction the flows are coming. So I think here it's just perfectly clear that you know, we are probably rightly positioned. Having said that, I think there's always a bit of a danger of bubbles forming with these very large flows. And if you look, for example, on the renewable sector, I guess it's clear that renewables is the cheapest source of electricity for 2/3 of the world now, or solar energy rather, but wind is also getting very affordable. So we had, you know, some of these companies going up 500% last year. But for some of them, I mean, one company, which is a Chinese kind of producer of materials for the solar cells, they had earnings growth of 200% last year and 130% this year. Well, then maybe it's fair that it's up 500% on trading at P19. That's probably a kind of where it should be trading. But there are other companies that are 500% on trading at P50, which is probably too expensive. And yet at the same time, again, speaking about China here, you can find, for example, producers of offshore wind turbines, which is the new large growth area at P15. And you're probably going to see 40-50% earnings growth for those companies for a couple of years, annualized kind of growth. So I think these valuations are a little bit all over the place here. So, you know, it's true that sustainability in ESG is the new trend, but I think you need to be a little bit careful which stocks you pick. Having said that, I do think that there are plenty of opportunities and growth potential left in some of these names.
Thank you, Jacob. And if we now take a bit of a step back to Stockholm, and Anders, what are the key events to watch this year?
Well, in the short run, I think it's all about COVID and the efficiency of vaccine, the psychological reaction, the pace of the opening, the degree of relief that we could see for restaurants, hotels, traveling when this is over. The clinical trials are good, but we would really like to see it pan out in data. I think for emerging markets, it's very interesting to see what is happening in the sub-Indian continent. The structural reforms there has been some protests, but they are also moving forward. If India could go into a period where labor market reforms, agriculture reforms, and other structural changes could kind of reinforce growth, that would be very, very interesting. Obviously, China is in a very strong position. It's basically, as Peter pointed out, a tech market. You're basically investing in very interesting corporates. And I do see that the retail entry into the market is very important, because you get the constituency, a local constituency that is pushing governance issues. It is one thing that you could be tough on foreign owners, but if it's the local population's long-term pension savings that are in the stock market, that is changing the governance dynamics. That's very positive for ESG, but it's also pushing a more shareholder-friendly policy in many of these companies.
So owners will feel the responsibility to do good.
Yeah, and I do think that it's very important, not least from a political perspective, that you get retail investors and pensions invested in the stock market as a long-term culture of ownership that is kind of reinforcing the sustainability of market reforms.
I think it's very important, and also we can also point out that many of the markets we are acting in also didn't really have proper capital markets, say 20 years ago. And when you actually see people understanding the difference between shareholders, boards, management, and all these things, why are you in a stock market, how do you need to act, what do you need to report, transparency, these things will continue to transform these countries to the better.
And then we've been discussing a couple of sectors, but would be still good to hear a bit more on that. So Jacob, which are the sectors that we actually like for this year?
Yeah, I mentioned renewables, but I think another maybe less obvious thing is just to invest into the offline companies that are becoming online leaders in their respective areas. I will give you a very kind of blunt and simple example. I have 4 kids, and we have been living now in Sweden during COVID, and now I'm back in Moscow with half the family. When we order food online here, it takes 1 hour to get everything, and delivery is free. If I was to go food shopping on my own, well, that's probably more like a 1.5 hour exercise, and going through traffic jams, finding a parking space, carrying everything, etc. And I think my wife would be slightly less enthusiastic about such exercise as well. So it's 1 hour, it's super convenient. In Sweden, it took us 2 days to get food delivery home. So of course, emerging markets develops not in steps, but in leaps. And this is such an example. The company which is doing this has a market capitalization of $10 billion. They started this because we pushed them. We told them that we think you should be doing this, but I guess it's a good company, and they realized themselves as well. And now the value of that e-grocery business is $3 billion, so it's 30% of the market value of the company, which is great, right? So you buy into something which is attractively valued, pays you 7% dividend yield, but then also has high growth because of the online segment that eventually actually now might be listed separately. So I think, you know, you need to just have this tech and disruption as underlying themes, but sometimes, you know, looking at at different places than the most obvious ones just probably will give you better return, because the most obvious examples would be just very, very expensive on the stock market.
Okay, thank you very much for that. And I think also a topic that we touched upon, because now we would move into the Q&A session, the most exciting part would be value versus growth, i.e. tech. So this is one of the questions that we have received. And the second one, how we see the retail participation actually affecting the market. So when do we actually really have to start thinking, if we are not already doing that, on how that can affect stock prices? So I think, Jacob, it would be great if you could start that one.
So the first was on value and growth, and the second was on retail, yeah?
Exactly, and how it affects markets.
Yeah, so if I start in the end that, you know, wherever all of this money go, again, after the global financial crisis, a lot of this money also went into fixed income. And now a lot of the world's bonds are trading with a negative yield, and there are even corporate bonds trading with a negative yield. And those same corporates, even in developed markets, can be paying you 10% dividend yield. There are such examples of just very stable businesses. So I think if you take that view, it's pretty clear that equities globally would be the preferred asset class. And maybe if you take that view, some of the money from the fixed income probably will be moving, you know, towards those stable equities or stable yield equities, which is probably the value case. So I think that speaks for value. But at the same time, we live in a more disruptive world where things are probably changing faster than ever. And of course, the whole corporate landscape is being changed. Just take the automotive industry. Where is the value or value creation in this industry? Well, it's obviously in electric vehicles, right? But then, you know, who's gonna dominate that? We don't know. Is it the new upcomers like Tesla and NIO in China? Is it the German ones just kind of recalibrating their business models? Or is it the materials producers, the guys producing the batteries, which is a significant cost and which is actually quite difficult to produce, and with a large kind of technological angle or component to it. So so try to answer your question. Unfortunately, I probably need to say both. And in a way, there are also companies with good valuations that are growing. So we try to find that. It's not always easy, of course. On the retail side, well, what we have seen is that they are a bit of shock absorbers. So if there is a very significant downturn, the local retail market and the local institutional market, which is also growing, is there in a way to absorb the outflows from foreigners. So emerging market as an asset class is becoming less volatile due to this. And I think this is also very important to note. It is also the case that tech is a larger part of emerging markets. It's roughly 40% of emerging market indices, and you used to have oil and gas and materials being 30-40%, and that has been basically replaced by tech, and tech is probably a less volatile also sector than commodities, right? So overall, I would say that it is clearly positive in terms of a shock absorber, but long term it is also going to fuel the stock markets, right? Because it's just constant inflows. It's someone buying the market every day, which slowly will push the markets higher.
If I can add a point on the tech sector, I think it's quite interesting to note that if you look at discounted cash flow, they really can bring growth. With their business model, they are capital light, which means that the return on invested capital are often very constructive. And let's also note on the governance side that many of these companies in Asia, China, India, or even Russia comes from new structures, young people, often with an education in one of the US top universities. They spend a couple of years in Google and then they go home. So it's a completely different governance structure. It's a culture where you're much more prone to argue the ESG case, where you're not linked to historical, let's call them oligarchs. And the combination of this business model and a new set of owners, I think is very constructive. And let's face it, if you compare it to the valuations that we see in terms of PE numbers, multiples in the US and Europe, you can often find very interesting business cases where you can, I think, actually see a very strong development going forward.
And I would completely agree. And if you would exclude China, where you have very high digitalization ratios, if you look at the rest of the emerging markets, they're actually quite far behind what we see in the West. So it would be everything, as Jacob mentioned, e-groceries, it could be general e-commerce.
Payments, fintech, e-health.
Exactly. So you just need to either find the new tech company, so to speak, or they could be, as Jacob mentioned, a standard or an old school, so to speak, retailer that actually goes into digitalization successfully. But of course, if you have 3-4 retail companies in the market, there will only be one winner, and that's basically where we come in. And speaking about ESG, also I wanted to hear Peter a bit more on how we actually think about ESG when we invest.
Yes, thank you. It is key for us to have that as a part of our investment case and investment sort of analysis. Ever since we started the company back in 1997, it's been one of the first things we have been looking at. We try to understand who are the owners, and are they the good guys, are they the bad guys, and can we trust these guys? And I think owner is a key word, because when we do buy a share, we try to act as we own it. We don't try to see it only as an investment. And I think if you're an investor or an owner, it actually creates a different mindset on how you actually approach the company. And that means that how you engage, we like to engage, we like to nudge companies in what we think is the right direction. And I think over the years we have so many good cases of how we've been able to actually transform companies in our little own way and help the development. So,
I can tell you, I just came from a meeting today, a physical meeting. They are rare these days, but a physical meeting here in Moscow, where the main owner of the company asked for our feedback before they are drawing their own strategy for the company. So it's quite interesting that before even making their own strategy, they come to us as significant minority shareholders and actually ask, what should we do? Which direction should we basically we be looking at? So it's interesting, of course, that we can have this type of dialogue, and of course, and also influence companies in a positive direction.
Absolutely, and that's from the governance and the strategy, of course, and then we're also working a lot on trying to influence companies on the environmental side as well, which is key, of course, also on the social side. But you can do a lot if you're an owner and not only an investor, or perceived as an owner and not only an investor, as you're there for the long term.
And I think there are two driving forces here. First of all, people in emerging markets want to be sustainable. So this is a societal demand on the corporates. But also, if you look at the new trends in electric vehicles and so forth, it's pretty clear that you can't produce those batteries out of mining industry that really is a big polluter. So the end customer is increasing the demand. So we also have I think a really transformational change in the mindset, not the least in the mining sector on how they are actually acting and investing. It's a good business case to reduce your sulfur emissions.
Definitely, and we are pushing the companies a lot, and you can really make a big difference, because if an oil and gas company or as you said, it will be a miner, would decrease their emissions, they are so big, these companies. So in relationship to, let's say, the carbon emissions of Sweden or similar numbers, it would be it's quite staggering what type of impact you can have. And also, I think one question that we also definitely need to discuss, especially with Jacob on the ground in Moscow, is Navalny, who unfortunately got very sad news about his jail time of 2.5 years. So, Jacob, what is your view on this, and will this impact the market?
Yeah, so I was going with my son to the office yesterday morning. He's doing this homeschooling now in quarantine for 2 weeks before he can go to the physical school. And we went past a riot police. So I have some good photos with him and the riot police that were kind of gearing up for protesters, because I guess they knew they would come after the trial that was held yesterday. Well, it's of course it's a bit sad. I had lunch with Navalny a couple of times, so I know him. I think the protests are more linked to against corruption, which unfortunately we have in emerging markets. We wish there was no corruption, but it does exist. And he got a sentence of 3.5 years, but he has already been in kind of house arrest, so it will be 2 years and 8 months of a prison sentence. I think we'll probably see a bit more of protests related to this. I don't think they will be huge. I have a lot of friends, who would be participating in the previous rallies a couple of years ago, and they have not been out protesting now. So it's more a really kind of young generation, I think, and simply less people out in Moscow, more in other parts of Russia, but less in Moscow. So I think we'll see what comes out of it. Perhaps some sanctions from the EU and the US, but we got some indications now from the US yesterday that we are looking at so-called individual sanctions against the individuals, perhaps putting him in jail, etc. These are not market-moving sanctions, and the Russian market was up massively yesterday, maybe a bit ironically, but the market does not pay so much attention to this. It is not like you had in the past, where you had big sanctions on Russia and the ruble at half of its value, etc. This is not what we're seeing now, and not what we're expecting either.
I do think one should say that there is a big geopolitical risk around Russia. Everybody knows that. We do have the parliamentary election in September, and the support for United Russia has fallen after the pension reform. But I do think also that this could potentially also be a little bit of an upside. The dissatisfaction that we see now in the streets in Moscow is about the government's inability to deliver a better living standard. The voters are not asking for another geopolitical adventure. They are really wanting a government that can come back with a constructive attitude to Europe, to the US. And in the longer run, it's pretty clear that Russia is a European country. They need to realign with the rest of Europe to be able to sustain growth. And so far, Putin has not been able to deliver that. But I think the demand and the pressure of him to move in that direction is increasing.
And on that note, I would ask Peter for some conclusions.
Yeah. So we are looking at the 2021, which we think will be pretty good from an economic point of view. We will see strong economic growth in most areas of the world. I would say almost all areas of the world. This is because of the stimulus, both fiscal and monetary, which will create a demand in many parts of the world and in many sectors. This in turn also will be good for commodities, which is also good for emerging markets. So it's no surprise that on a recent survey the Bank of America did with more than 200 asset managers globally, with more than $500 billion under management, that the #1 trade for 2021 was predicted to be global emerging markets. And if we then add on that we see this very strong sustainable trend where we're well positioned in this field, but we're also looking at emerging markets which are trading at 30% discount of developed markets, and also with stronger earnings growth. I think we can sum up pretty good case for the year. Thank you.
And on that positive note, I would thank you all for joining us today, and please join us for our other webinars, again, China, frontier markets, and Eastern Europe. And have a lovely evening.